All right, good afternoon. How's everyone doing? My name is Ernesto Pacheco, you can see here, and I'm an independent financial professional. My company is Freedom Insurance and Financial Solutions. I am located in the west suburbs of Chicago, and here's my contact information. I've been in the industry since 2004, and I love what I do. And let me just get started here. As an independent professional, we're able to secure relationships with many of the companies and carriers that you see here. Okay, we're not loyal to any one of these companies, or we're actually we'll put our clients' interests best first, and we'll see which one can meet the needs best, right? All these carriers and companies have great products and benefits, and depending on the one that makes sense for our clients, that's the one we go with. So, a little bit about myself. I started back in 2004 in the banking arena, which back then was Bank One. Now it's Chase Bank. And I did some time at Allstate Financial with some very high producing and very holistic advisors and planners over in that arena. I was with Mass Mutual and picked up some great planning tips from this carrier. They have some great products as well. I did own a property and casualty agency with Farmers for just over 5 years, and I do have my securities licenses in there over at Transamerica Financial Advisors, one of the premier giants in the industry. But again, my company is Freedom Insurance and Financial Solutions, and I work with a variety of different products and solutions. But right now, just because of the demographics, Medicare is a very strong tool and that I use, just basically because more people need it, right? And we explain it, and there's other ancillary benefits that we cover, such as the ones you see here: the dental, vision, and hearing plans, hospital indemnity, cancer plans, final expense. With the licenses that we have, life insurance is always going to be a prevalent tool that we help people and households all across the country. Qualified plans, 401ks, which is just a code in the textbook, 403b plans, annuities, and so forth. So that being said, one of the questions people ask me a lot, about life insurance, right? I kind of just go over why really people buy life insurance, and the main reasons are, from what I've seen, is that a lot of times we got to take care of our kids, right, and their futures, or we're taking care of aging parents, right? So we become that sandwich generation, where the people that we take care of, the needs of our kids as far as their household, their living, and their future in terms of college and whatnot, and then the parents, right? They may have some needs and need that in terms of their either medical or assisted living. And the second reason people usually get insurance is because they have they co-signed on a loan, right? Third reason that I've seen people enter into a partnership and they have a business they have to protect, and so life insurance is a valuable tool there. And a lot of people actually, and I would tell you, more than 90% of Congress invest money into life insurance policies because of the mechanics, the way they work. And we can see here there's Internal Revenue Code 7702. We'll talk about that in a bit, but the way this works, it's very beneficial, right? And some people just, they want to leave a legacy to, because they're passionate about it, maybe to a nonprofit organization. But these are overwhelmingly the reasons why people get life insurance. So you have two types of plans: term insurance and permanent insurance. Whatever carrier it is, these are the two plans that they can offer. Okay, and term is what we like to call temporary insurance, because you can get it from 10 years all the way to 30 years. And once that term is up, though, the insurance is finished. It's not finished exactly. They will renew it, but all the years they kept the premium or the price you paid level. Now they're going to increase it, and it gets very, very expensive. So people usually either cancel it at that point or they convert it. But the cost is very affordable. Okay, but it has no cash value. Okay, then we go to permanent insurance. Okay, and with permanent insurance, it's designed to last all of your life. Okay, and what happens here is that you do have, excuse me here. you do have cash building up inside of this policy that allows for living benefits. So people usually don't associate living benefits with life insurance. They think, hey, Ernesto, I'm not ready to die. So let's talk about something else. And that's not how it works, right? Because living benefits, comes with cash and having flexibility, right? And oops. So the cash that comes out of there will come out if structured properly, with tax advantages, basically, right? And we'll get more into that here in a second. But I want to touch base real quick on financial security because it all makes sense as far as where we're headed and where we're at now. But we got to take a look at where we were at. So if we were gonna retire one day, we just we're gonna set retirement on top of a three-legged stool. What would that look like? Well, that three-legged stool would look like this. It would be three legs, each leg representing three separate facets. Social Security being one, company pensions being another, and personal savings being the third. If we take these one at a time, pensions, when I was a kid, my parents would say, get a job, good paying job, and get a pension, because a pension was a guarantee that you'd have a retirement plan the day that you retired, right? In the 1980s, and we see here, over 60% of companies operated a pension for their employees, which is also known as a defined benefit plan, okay? But ERISA, the Employment Retirement and Security Act, they added a different retirement plan that was available to employers, and 17% of companies were operating this plan, which is also known as a defined contribution plan, better known as Internal Revenue Code 401 subchapter K, 401k. So 401ks started to progressively show up more or be the primary plan in people's employments or jobs, right? But what's the difference here? Is that the difference is that you're responsible for your retirement plan as an employee. The employer can match, but are not required to, okay? And depending on how the market does, that's how your retirement plan is going to go. So people remember 2001 and 2008. Those were difficult years where more than 50% of people's portfolios were lost. And unfortunately, we don't see that the stability is going to be something we're going to be experiencing in the upcoming decades. So if 401ks are people's primary retirement plans, how do you know how much money you're going to have in the future? Number one, because you don't know what your account's going to look like due to fluctuations. And number two, because of taxes. And we'll talk about that in a second. So pension plans are kind of, they're gone really, unless you're a nonprofit. But let's take the second category, which is Social Security. And what I really want to kind of elaborate here or kind of expound on is with Social Security, it's the hallmark of the Roosevelt administration, okay? And when it started, it started in 1935, but this is just a snapshot of 1945 versus 2016. And the area I want to focus on is how many people were paying into the system in 1935 and 1945, which 42 people were getting deducted FICA from their check for one person collecting benefits, right? If you fast forward that to today, there's 2.8 people, right, getting deducted from their check for one person collecting benefits. And that's kind of a concern, because not only are back then only 222,000 people collecting Social Security, but their average annual payout was $220, okay? So it was a well-funded plan. But if you fast forward today, 59 million people are collecting benefits, and their average payout is $18,462. Again, 2.8 people are only paying for one person collecting benefits. We have a problem, right? So move on here. I wanted to touch base real quick on how money works. And real briefly, if we go back to this slide, I'll give you an interesting statistic. Out of all the Western nations that save money, we are dead last amongst all those nations. We save 2% as Americans. That's not a good number, right? So Our retirement stool is a little bit waning there, but it's not all doom and gloom. I'll go into some other areas where we can help out. So I like to cover really how money works, and this is really talking about the rule of 72s. It's a rule that I had learned from some of my previous companies. If you take your interest rate you're getting on your money, right, and you divide it into 72, it'll tell you how fast your money is going to double, right? This is a rule that was discovered by Albert Einstein. Everyone remembers him, famous hair model and mathematician, but no. So if we look at how fast our money doubles over the years, okay, we go from 4% to 6% to 8%. We look at the different endings, right? But if we actually go to 12%, you see that money's doubling every 6 years, because if you divide 12 into 72, that means your money doubles every 6 years. So if you started with the same amount at 29, at 65, it's significantly different than where you would be as if you were to have gotten 4%. Huge difference, right? Just real quick food for thought. Credit cards work the same way. If you have an interest rate on a credit card, it's 12%, and you're paying the minimums. Here's what's happening to your debt. It's compounding fast. So compound interest is the eighth wonder of the world. We operate that within life insurance, and especially on permanent life insurance policies. And we'll talk more about that. So you have 3 different options of how your money can grow. These are pretty straightforward. People are familiar with these. So we have a fixed option or strategy, which basically your money is safe. That's the number one value factor with fixed strategies. Second, you have variable, which variable, just how it looks here, it's like the roller coaster, right? You don't know when your money's going to go up and when it's going to go down, but you're along for the ride. Hopefully, when you really need the money, you're not in one of these downward slopes, right? And third, really, if you took the best of both of these 2 strategies, you would come up with a strategy called an index strategy. So every time the market went up, right, your money would go with the market. And then when the market would drop, you would stay where you were at, kind of a lock and reset, which is why you have these little locks here, right? So your account really, because you have the guarantee or the safety of a fixed strategy, but you still have the option of growth with a variable, your account ends up looking like this. And let's take a look at a real quick scenario of how that will work here. So if you have $100,000, right, and you were going to lock the gains every year that it went up, right, and not participate in the down years, here's how it would look. 100,000, next year 10%, right, you're 110,000. Then you would drop, the market would drop 15%, right? And but if you were in an index strategy, you would have stayed put. The following year, it would have been at 5%. Then you would have gone up to 115%, 5,000. I'm sorry, 115,500 if you were in an index strategy. And obviously, we see what everybody else in their 401ks and their portfolios did. So you have a 17-point spread. I'm sorry, a 17% spread. Big difference. So the index strategy seems to make sense for a lot of people. Okay. That being said, the effect of taxes, this cannot be understated. Okay, taxes will be the number one reason why people now don't even become financially free, but maybe not even retire, right? Because the way we're headed, and I'll show you real quick, it looks like taxes are going to be the number one reason why we have challenges with our retirement. So you can have 3 tax buckets where you can put your money, and I'll leave that up to you after I explain this. The first strategy is here you get, whether you put money in any of these strategies, the bank in this case, or whatever financial company is going to send you a cute little love note, right? IRS actually, it'll be a 1099. So you're going to pay taxes after 12 months on any of the investments in here. So that's a taxable bucket. The second bucket is a tax deferred bucket. And with the tax deferred bucket, right, we're going to go ahead and defer taxation on all these instruments. So everything 401ks, 403bs, IRAs, annuities, pensions, savings bonds, the taxes on this are going to be deferred. So the thing about this is if you don't know what your tax rate's going to be in retirement, how do you know how much money you have? That's a big issue, right? And thirdly, we have a tax advantage or tax-free bucket. I will tell you, more than 90% of Congress invest their money in this strategy. Roth IRAs, permanent life insurance, municipal bonds, 529 plans, HSAs. So if you had $100 or you had an extra $200, where would you like to put the majority of your money? Most people tell me, Ernesto, it makes sense to put some of that money in that tax advantage bucket. Because if you're telling me taxes are going to go increase, marginal tax rates are going to increase, then maybe I should take advantage of this, right? So that being said, let me tell you a quick story here, because the demographics of the country are what's changing how the tax rates are going to go, right? If we, if you look at back our history, back in, in the early 1900s here, from 1901 to 1924, anybody born in this time frame was known as the greatest generation, okay? This is what Tom Brokaw referred to them. These are the people that fought in World War II, right? And they helped us coming out of that Great Depression. The second subgroup of this timeline would be the silent generation, the Bob Hope generation, right? Still kind of reeling from the Great Depression, and but there was a statistical anomaly that happened, because after 1945, where the silent generation cut off, there was a group that came in and changed America forever, which are known as the baby boomers, as we can see here, right? On the rise, 76 million babies, over this time frame between 1946 and 1964, right? Oops, I went too fast there. So this includes people who are between 51 and 70 years of age in 2016, or 52 and 71 in 2017. So Generation Xers are children of the baby boomers, right? Also known as, Generation X many times because the baby busters, because we started the decline on birth rates. So anyone from 1965 to 1980 is known as the Generation Xers, right? And then we had, of course, Generation Y, the millennials, who really from 1980 to 2000. Why is this important? Because if you look at the anomaly of humans in population size in our country, this right here is a reason why we're going to have issues not only with Social Security and Medicare and other expenditures of the government. Here's the national debt, and this is actually as of last year, November 15th, $19 trillion, right? So what does that mean? Really, if you took 1 million seconds, right, you would have 13 days. If you took 1 billion seconds, you would have 31 years. But if you had 1 trillion seconds, that would accumulate for 31,000 years, right? So not to underestimate 1 trillion, right? But we have $19 trillion in the hole, okay? So when Congress talks about raising the debt ceiling by $1 trillion, it's not a small deal. With $1 trillion, every graduating high school senior in the United States we could buy a Porsche for them for the next 4 years. So next time we say we're going to raise the debt ceiling, say no thanks, I'll take my Porsche instead, right? So where do our tax dollars go as of 2016? For every tax dollar that we pay in, like 66 cents go towards the national debt, Social Security, Medicare, and Medicaid, right? And if we fast forward to the year 2020, for every dollar of our tax dollars, where's that going to go? 92 cents are going to be consumed by the same 4 things, which really leaves this 8 cents left for everything else, right? Can we run the country on 8 cents to the dollar, right? The CIA, public parks, educational funding? No, we cannot. So that's a problem, right? Now, there's a person by the name of David Walker. He was the United States General Comptroller, also better known as the CPA of the USA. He served under the Clinton and Bush administrations, okay? And basically, he resigned from the position as General Comptroller because he saw the numbers, right? And he said that something's not making sense here. He was vetted by Congress because he was saying that if we don't double the tax rate, this is back in 2008, if we don't double the tax rate immediately every year that we delay, we're going to go in the hole by an additional $3 trillion. And what will end up becoming of this country is kind of a credit card that's only paying the minimum payments, which we're not even going to be able to scratch the principal. The debt will eat us alive, right? Again, he served for 10 years as the chief auditor, right, on the Social Security Board. So I think he's well qualified to talk about this. But he said, you know what? 2015, Social Security is going to have problem paying for its own obligations, but that's small compared to year 2020 because Medicare will no longer be able to provide for its obligations, right? So that being said, he said there's 4 solutions to the debt problem, okay? And this is going to make sense here with the life insurance conversation. So there's four solutions. The first solution we could have is we can cut expenses. Okay, so every congressman can go back to their constituents and say, hey, we're going to cut your Social Security, we're going to cut your Medicare, we're going to cut school grants, and see how that goes, right? And unfortunately for a lot of those guys and gals, they get a new title. It's former congressmen and former congresswomen. So this is really not going to work. Okay, the second thing we can do is maybe we can borrow the money, right? And we already see some of the subsectors and countries that we owe money to as it is, right? China being the number one on this list. We owe them $1.2 trillion. They're concerned about getting that back, so they're not really in the lending mood with us right now, right? So we probably can't borrow the money. And again, this is as of November 2016. So option number three is printing the money, right? Something we could just go ahead and print our money, and that's not an option because hyperinflation really takes over. We have a country that has set a good example of what they did. This is a $100 trillion bill in Zimbabwe, right? And for years, they weren't producing any gross domestic product. They were printing their currency to pay bills, and that came to backfire because today, this bill can buy you can buy this bill for $3.99 plus shipping and handling, or you can buy a loaf of bread with this bill in Zimbabwe, right? And that's unfortunate, but that's what happens when you print money. So that's not the option because hyperinflation takes over. The last thing is we can rely on the full faith and credit of the U.S. taxpayer. What does that mean? Somebody said, what does that mean? Yeah, it means that the government has a plan, and here's what they're going to go ahead and rely on our taxes, right? So unfortunately, this is where it's headed. And if we're going to be in line to pay higher taxes, and we're looking at those three tax buckets, I think it's time to start familiarizing ourselves with that last tax bucket, the tax advantage bucket, right? So let me go a little more into that, and we're almost done here. So David Walker also said, if we're not going to go ahead and raise taxes, right, and we can't do the other three solutions, then we're going to have to wait till a deciding year, right? So here's what's going to have to happen. Many you can see here is a graduated cylinder. That's how our tax structure is now. So all the money that goes in here, right, we're taxed as we make more money, we get taxed higher. So how does that look today? For the as we start making money, we're taxed at starting at 10%, right? And it goes gradually all the way up to 39.6%. This gentleman, David Walker, who is the CPA of the USA, said, if we wait and we delay, we're going to have to change our tax structure to these three different tax brackets. Everyone will pay, 25%, and then they will pay 63%, and then they will pay 88%. How does that sound, right? And people aren't excited about that because this is the year it's doomsday. If we don't change our taxes and we don't increase taxes by the year 2023, that's when our country goes into a national default status. Okay, so remember, you hear that here, and this is information from David Walker. This is not my information. Don't shoot the messenger here. Okay. Lastly, if we look at tax rates today, here's where they are at 39.6. And let me go ahead and just, for some of you that aren't able to see that, if we look what we have here, this is as of 2015, and they haven't changed still since, right? So 39.6. What's the highest they've ever been? As we can see here, 1945, 94%, right? And unfortunately, back in 1945, we were involved in World War II, and we needed to have revenue to fund the war. Now, we're not in any war right now, but we have just as much debt now as we did back then. Possibly we're going to surpass that. So the government knows what we're going to have to do, and we're all going to have to get in line to pay our taxes, right? Now, if you're depending on retiring, you're hoping on retiring, right, and setting money aside, may be of interest to you to look at some of these strategies because we don't know what's going to happen in these years. Real quick, because we're finishing up here, provisional income is something right now that most retirees are unaware of. This is a sheet from BlackRock, which is a financial company, right? Basically saying this: if you retire and you're single in retirement and you make above $34,000 a year, you are going to be responsible for paying 85% taxes on that Social Security, right? And that's unfortunate. Anybody who makes between 25 and 34,000 we see they will be paying 50% in taxes on that Social Security income, right? However, what does it look like if you're a joint? Now you went 44,000 for the year on a joint couple household. So if you make more than $3,667 a month in income per month as a couple in retirees, so you're going to have to pay this tax rate as well on your Social Security income, right? Which can be significant. So if that's the case, then obviously we have some things to talk about. Listen, I'm done with this. My name's Ernesto Pacheco, okay? And, you know, this is just some of the strategies we talk about. Here's a picture of my office. I'm located out in the west suburbs. For those of you that are familiar with the area, we're just west of Route 59. Here's my contact information. This is my office line. You can reach me also on my mobile, which you'll see over here on the right-hand side. Look forward to talking to you, and have a great day.